Hey guys, welcome back to our investor series. I'm Mark Mann. I'm here with Brian, and we're with Realty Consultants Property Management, and we're going to talk today about a timely subject in getting your deals financed and the financing process when going through the real estate investing world. Brian, talk to us a little bit about, I know we've talked in other episodes about the types of financing. We're going to go back into that world, but the market that we're in right now, we're kind of coming at a little bit of a shift. I hate that word, but a little bit of a shift, an uptick in the cost of money. I mean, the cost of capital. For so long, money has been basically free or really, really cheap to get into, and now things are adjusting. It's costing a little bit more with the rising interest rates. And so what can real estate investors do now, as things are ticking up, but also as they may stay up, to make sure that the investing they're doing makes sense going in a leverage situation?
Yeah, I mean, the biggest thing is just understanding the cost. Hopefully, you all, as you're modeling out all your expenses and your cash flow models, you've got this piece in there, your borrowing cost within there. It's just understanding what it's going to be. Here's the thing: rising interest rates aren't going to kill you unless you have zero margin to deal with. But knowing what it's going to be and how to handle it is probably the most important.
Absolutely. So, and it kind of goes back to a conversation we've had, which is that cash flow versus appreciation type of purchase. If you're dealing with if your mindset and your strategy was, I'm going to buy, properties that are going to appreciate more, cash flow is less of an issue. These, your margins are typically thinner. So if the cost of money goes up, the cost of your loan goes up, it's going to be a little bit more of a tricky situation with those higher end properties.
Yeah. I mean, at the end of the day, it really is it's basically the cost. It's a cost component of the expense model. But what are some things? What are some things we can do, or what are some things that are going to happen to offset that? First of all, and again, this is a component of the inflation piece that we're dealing with.
Right.
And as most of you all know, real estate's probably one of the best hedges for inflation, because everything's going to go up about so your value and your property, your rents are going to increase. All that's kind of happening. So that's kind of the offset of the rising expense component. There's going to be some rising of the revenue as well.
So what you're saying is that just because money's more expensive today shouldn't prevent me from looking at good deals to get into them right now, just because money's more expensive. I should go ahead and get into these deals because I'm also going to realize the higher appreciation just because of inflation, and then also the higher rent values, which will typically cover the cost of the higher cost of money.
Correct.
So that's important to know as as you're looking at the modeling out, and walk us through the model, because I mean, an experienced investor knows what you're talking about. An experienced investor has their spreadsheet, their model of here's the deal, here's the cost, here's what it is. So walk us through the things that you take into consideration when looking at a deal, and obviously the cost of money coming into it. But what's that model look like for you?
It's very difficult.
Yeah.
And so many people have like different versions of it, but it's so difficult. It's rent minus mortgage minus property management fees, in my case, minus if you have HOA, basically any cost.
Any cost.
Taxes, insurance. What I do is I cut those by 12, because those are usually annual payments. So I'll cut those by 12 and put that. So this is a monthly model is what it is. And what you want to have is a positive number at the bottom. So it's basically rent minus everything else. What's my cash flow?
Right.
And if that's a positive number,
then it's potentially a deal that's worth looking at.
Correct.
If it's a negative number, maybe
then
probably no.
Right. It's probably not going to work.
Absolutely.
Now, that being said, so now we're back to the rising interest rate piece. If you have a variable rate mortgage or loan on this property, then that component is going to change in the model. Yeah. Well, you've already made the decision to purchase, but now you've got to change. So that's kind of what you have to get around.
Sure. And so walk us through that. So, I know if you're doing a conventional loan, most conventional loans that have been done in the past bit have been fixed rate mortgages. Even on the commercial side, if you're doing commercial type loans, they're typically fixed for at least a 5-year period or whatever you may have. But then there's the idea of people kind of bundling up money. So I know a number of our investors will have 50, 100, 200 doors that they manage, and they may have 3 mortgage or loan products for those. They're tied to different properties, and a lot of those are in variable type rates. So how do you manage that risk? What do you do if as the tides are shifting? Do you then take that refi and try to get that into a fixed rate product? What's the thought process there?
Well, anytime you can keep things as constant, it's better. So fixed rate is always going to be better just from a constant aspect of managing your business. There was a time when variable rates were better. The last, probably like you said, the last few years, the fixed rate's been better because the interest rate's been so much lower. Now as the interest rate's going up, and most people assume it's going to drop back down, not to where it was before, but we'll probably see this rising of the rate and then level off and then come back down a little bit. I don't know where it'll end up, but that's kind of the thought process. And so there will be a time for a variable rate where it'll be better, and it could be now to when they finish raising rates. That's probably going to be your best time to get that variable rate when it kind of tops out, because then your rate's going to vary based on what the Fed does. So if they start dropping rates, your rate will start to go down as well.
Right. So a lot of our clients, us included, utilize the Burr Method or Burr strategy for purchasing real estate. And for those that you're not familiar with that, it's basically you buy, you rehab, you rent it, and then you refinance it, right? In that method, you are in the refinance, so you've bought it and then you've refinanced it over, let's call it a 6-month period of time because you've added value. You go in and you're going to pull out what capital that you had into it. And the goal is to basically pull out as much of your personal funds out of the deal to move forward. In the market of increased cost of money, when you're going in and you have this refinance situation and the costs have risen, let's talk about in that the over leverage piece. So I know that when we taking a step back, when we're looking at kind of a 30,000 foot view, it's a very scary period of time for some people, new investor who have only invested in that cheap money, highly appreciative, great market, that, as the market adjusts, could find themselves in an over leveraged situation. What are the dangers with that? What can you do to mitigate those sort of threats to your business? And how do you kind of level it out and have a little bit more of a level playing field with respect to that?
Yeah. So the best way to put the Burr Method in layman's terms is it's kind of like using your investment property as an ATM. So we heard about that back in the late 2000s, that people were doing that, and that led to like massive bad things in the housing market, right? But that's basically what you're doing. Now, as long as you take care of the situation, you're fine. But you just have to know when you are 100% or even more sometimes in a loan to a value, then there's going to be a cost there. Now, it makes it more dangerous when you see interest rates changing like right now. Because again, you're back to the model, your expense model. And if your expense model gets to the point where you're in negative, well, you're not in a good spot there.
Right.
And if all the funds have been used somewhere else and you can't get to them to be able to handle the expense piece, then you got a problem.
Absolutely. And so along those same lines, and you've talked about this before, it then gets back into that situation where, being over leveraged on a handful of properties versus being having leverage in multiple a larger swath of properties is a lot easier to manage, because at the end of the day, the cash flow should be taking care of all of it. And if you have cash flow from multiple sources, the risk of vacancy costs, rehab costs decreases as your portfolio grows.
Yeah, and good, bad, and the ugly of it, history repeats itself. I do not believe we're going to have a 2008 downturn, like some may say out there. However, this is exactly what happened during that time, and investors during that time over-leveraged themselves. They had way too much debt on their property, and the downturn bit them in the butt.
Yeah. Well, and in that same thought process, there's a component that was present then that is not present now, and that is the inventory supply of homes versus the number of people that need to be in the homes.
Right. Yeah.
So currently, right now, we live in a market where we are, we're short on housing. You have multi-generational families coming together and living together because they can't get a house. Right. Whereas in 2008, we had way too much inventory, too much building, too much of literally vacant houses and vacant projects sitting in the realms waiting to go. So that piece comes off the table. So you've removed a big risk component that is not really in the individual real estate investing world, but does have an effect.
Yeah, and really what hurt investors before that was the housing market as a whole, and I don't think we're going to go through that again. But what hurt investors the most was the fact that they were levered to the hilt. Banks really stopped loaning money, and it was easy to call those loans, or they couldn't afford the rent they were bringing in. They couldn't afford the payments because they were just so over levered and there was nowhere to get it. You are correct. The downside was that it was hard for them to sell it at that point in time too.
Right.
This time it wouldn't be the case.
As the market shifts and is shifting, one of the big ties in the real estate market and the housing market that we need to be aware of is the ties with home values or real estate values and the rental values as well. And typically there is a lagging jump. So as prices increases, rents typically increase, but they increase a little bit later. It takes a little bit of time to. So what we've seen in the past 2, 3, 4 years, where you've seen 15, 20% home value increases, talk to us about what the market anticipates and is starting to see in regards to rental prices and the rental market.
Yeah, I think you're going to see rents increase. There is a lag on appreciation of home values versus the rent. So the rents increase later after you see appreciation in home values. We've seen a bunch of appreciation already, but we've seen some rent increases. We've had rent increases for the last few years, but I think there's going to be a big jump that kind of coincides with the big jump in home values over the last 6, 8, 12 months.
Absolutely. So what that gives a real estate investor is opportunity. So right now, today, you have the opportunity to get into a situation where you can get into a deal and expect that the cash flow to increase over a period of time versus buying it at the top or a leveling off situation. So you can anticipate a rising a rental market. I've seen in various different areas, metro areas, rents are increasing right now, almost at the same rate as the home prices did in there, at the 20% stuff. So you're seeing in some markets where rates are going up 3, 4, 5% still, but there are some where they're going up 20%. And I think what you're going to find is different metro areas, different markets. It's all local. Real estate's all local, but you're going to continue to see that rising of rental markets to meet the increased cost, increased values, tax values go up, tax rates are going up, which all boils into the cost to the consumer. It all gets landed back at the consumer's foot,
Right.
and that gets passed on. So there's there's an upside for you as you're looking at your investment.
Yeah, I mean, so the huge opportunity right now is this. So whenever you're looking at an investment, you always want to be able to somehow add value. You need to know how that value is going to be added before you get into the project. So the big opportunity you have right now is you have an enormous amount of investors who are, for one reason or another, leaving. A lot of them are aging out. They're just ready to take. We've seen this rise in prices. I want to go ahead and take my money and run, get out of it. And then you're seeing this influx of new investors. The opportunity is this: a lot of the ones getting out, the rents have not been changed in 6 years. Yeah. So there's added value number one, getting up to a market rate, right? Going back to what we were talking about, then you have the market automatically adjusting. Yeah. You don't have anything to do with that. That's product number two. So the added value, the opportunity of adding value is so easy right now because of that.
Absolutely. And kind of that brings us and kind of wrap this up. And while we're here, why we have a property management company. That's why it's so important to partner with somebody who has their pulse on the market, who knows what's going on, can adjust rental rates as the market adjusts and as well as time goes on in an appropriate way, because those investors that you just mentioned that haven't raised rates in the last 6 years, 10 years sometimes, they have lost hundreds and hundreds of thousands of dollars in lost opportunity that you can never recoup. Yeah. And so having that company, having that firm that is looking out after not just your property and making sure it's being taken care of, but also making sure you're charging an appropriate market rate rent is super important to make sure that your investment in the long term is there, and you're able to realize the maximum amount of it as you can.
I would say if you're paying 10% in management fees to manage your properties, just to keep market rent, you're going to get that 10% back. So all the other stuff you don't have to deal with that the management company's dealing with, you essentially get for free.
That's right.
So people look at it's expensive. I can manage my own property. But the benefits that come with it, just getting to market rent makes it worth it.
Absolutely. Well, I appreciate your time. Hopefully this has been informative, and we will see you next time.